So we are introducing the dog collar portfolio. I specifically, you can only imagine how many dog pictures there are out there. And I didn't even go to TikTok or Instagram. I just Googled it. Um, okay, this is the one I chose. First of all, he's really cute. And secondly, okay, there are different ways to do every aspect of what I'm talking about: contrarian stock investing, put options, call options, every part of what I'm about to describe. To me, there's a correct way to do it and there's an incorrect way to do it. So this picture was perfect. Okay. I'm going to hopefully give you certainly what I believe, and hopefully what turns out to be the correct placement of these powerful tools. Okay. So a few slides on this and we'll show some examples and I'll take your questions. The research part of this. Okay. Like I said, historically solid companies, currently out of favor. What does that mean? In blue here, I try to give you some sort of bottom lines. Since so much of this is, let's call it fresh conclusions to lots of research that's been going on for a long time. I don't have all of this, let's say, in beautiful presentation form just yet, but the subscribers are soon going to have essentially a dog collar analysis tool that I'm going to create, use it for myself. You'll see a little bit of a hint to it now, and we'll try to figure out ways that we can make it very easy to use. Because technically, I might end up with a portfolio of, I don't know, 10, 15 stocks, maybe 20 stocks doing this at most. But you can do it with almost anything, almost any stock, any ETF. So again, I'm not in the business of providing personalized advice anymore. I'm not a fiduciary anymore. I did that for decades, and 5 years ago we sold the practice. And so now I'm providing the concepts and the ongoing research and opinions. As the subscribers know, we're very active in the chat room and all that. And on these weekly sessions. So I'm providing the little bit of nudge forward so that everybody can walk down their own path toward what they want with this. And yeah, you can copy all my trades. That's part of the service. But I think for a lot of people, they like to know, okay, this is what Rob's doing, but I'm different from every other person on this call and every other person that would consider this. So yeah, you have to customize it for yourself. So I am looking generally at 20% or more off their highs. Not a hard and fast rule, but that's kind of what floats into my mind. Okay. And then again, we're going to use YARP, yield at a reasonable price. Now, what does that mean? Again, a score above 80 and dropping. So think of it this way. If you look at the last 7 years of dividend, like I showed on that previous slide, last 7 years, the dividend of stock XYZ is a lot closer to its highest yield than its lowest yield. Okay, it's cheap on a yield basis. And I define that as typically it's in the upper 20% of the last 7 years. Okay, so again, simple math. If it's traded between a 6% and a 3% yield, that's a 3% top to bottom. So 80% would be 2.4. So let's say it's selling, it's been between 3 and 6. It's around 5.4, 5.5. Okay, that's about an 80 YARP score. All right, but we can't look at it in isolation, because what happens is in YARP, a lot of stocks go to 99 and the stock just keeps falling and it stays at 99. It's one of the things my late father taught me about with charts. You never know when it's going to stop going up or stop going down. Just because it's in motion, it can stay in motion, as they say. All right, so we're going to look for out of favor, and the YARP is actually as good a tool as I can imagine. And yeah, I'm biased because I invented it, but it's designed for this. It really is, and for intermediate to long-term investing. And speaking of that, want to see the chart pattern. Look, I'm all about the charts ultimately. Okay, the market, I think, tells us a story. We just have to listen. And so I'm looking at charts where I say, okay, I think there's more upside potential than down at a lot, by a lot. but I will also consider what I call 50-50 situations. I almost put jump ball here, but I don't know if anybody would know that basketball analogy. But I guess when you start a jump ball, it's 50-50 who's going to win, okay? Unless you've got Manute Bol on one side and Muggsy Bogues on the other. If you NBA fans get that that joke. Didn't I say no more dad jokes? Yeah, that's what he said. So I look at this case by case, and look, the numbers all have to work. Okay, this can be made to be absolutely automatically by the book, but I've never really invested that way. I haven't fully automated what I do, most of it, but not all of it. Here's the other thing, and this is where it depends on how much money you're going to invest in something like this, okay? Because in order to buy a put or a call option, or sell a put or call option, unless you're doing, naked short selling, which is, when you don't own the shares, okay? You need to have another for something to be covered. Let's say a covered call writing situation. You have to have 100 shares because every options contract represents 100 shares of the stock on the put or the call side. So if you can't buy 100 shares, then you're going to be sort of miscalibrated there, and that can introduce some maybe unwanted things if things go wrong. So again, I mean, you can look at any stock at $100 or less, and that would be a $10,000 investment. Some people will look at $200 stocks. Some people will look at anything. Doesn't matter, because their portfolio size and their willingness to do something like this is so high that they don't care. They'll 100 shares of $1,000 stock, it's 100 grand. Okay, fine, drop in the bucket. Okay, I'm somewhere in the middle there. I'll probably will focus my own portfolio on a couple $100 and under. And really, when you think about it, it all kind of works out, because if a stock is selling for $500 or $1,000 a share or more, well, there are certainly some stocks that never split. But the other thing is, if a stock was, I don't know, $200 a few years ago and now it's 500, it's probably not out of favor. Okay, so it all kind of fits together, which is what is giving me, I think, a special amount of excitement about being able to do this and share with people. When I did this, over 15 years ago for private clients, it was a very small audience. It was we're a boutique shop. So the options market has to be sufficiently liquid. And I may adjust these a little bit, but in the research I've done so far that I'll show you shortly, 20 to 50 contracts a day or more, that to me is sufficiently liquid. There's also open interest, which is an options term. It has to do with how many contracts are actually out there, traded or owned by anybody, and usually like it to be at least that, if not, a bit higher, 100 or so. But we'll kind of feel our way around that as I build this out. And then I want to establish two lists, just like I've always done. Do I want to own it now? Well, then it can go in the portfolio. Or do I just want to consider it if? The if could be anything. Could be technical, could be fundamental, could be earnings are coming up and I don't want to mess with it right now, that type of thing. And that's what the watch list is for. And I've whittled it down quite a bit. Some best practices for this, and then I'll show you some examples. So what are we doing here? Well, you're buying the stock. You are then buying protective put options at or below the current price. So in other words, if the stock's here, the put option is here, and that defines your worst case for a period of time until the option expires. Out of the money, actually, it should be at the bottom here. I thought it was, but I've got a little footnote here on OTM is out of the money. So if the stock is at $50 and you strike a put option at $45, you are struck 10% out of the money, and of course, there's a cost to doing that too. And then I sell call options above the current price. Now, I probably should put another asterisk in here, but I haven't even shown you the first one, so I'll one at a time. But the uh, the thing about this is if the puts are cheap enough, selling the call options is capping your upside. Now, I'm going to say this right now, and I'll remind people if it comes up in the questions, because people say, well, if you sell covered call, there's so many funds that do this now. It's so popular, okay? Too popular, I think. And this is our custom version of that part of it. Okay, we pick the stocks, we pick the strike prices, you know, et cetera. It's all up to us. And I am quickly on the way to systematizing this so that I don't think the covered call ETF thing is necessarily going to be as attractive when you realize how much of this you can do on your own. And after all, we're all DIY, do it yourself investors. So, you know, covered call writing sometimes gets a bad name because people say, oh, you're going to cap your upside. And my response, I've said this to a million people in the comment section on Seeking Alpha after my articles. Is that really the case? Yeah, if a stock's at 50 and your call is struck at 60 and it goes to 60, well, that means that the more it goes above 60, the greater chance that you could be forced to sell the stock at 60. Is there no law against buying more shares? Is there no law against buying, I don't know, cheap out of the money call options so that if it goes to 61 or 62, okay, I don't mind getting called away. But if it goes to 65 or 70, heck yeah, I want to continue. And again, you can define your risk. And again, for those of you for you know who maybe are not as option savvy, we'll fill all this in, maybe not all today, but I can see this being the focus of these Monday sessions. You know, at least a bit of every one. Okay, I'm looking for 3-to-1 best case, worst case. I'll show you what that means in a minute. 3-to-1 upside, downside per month. Choose the strike prices in sync with the chart pattern when possible. Doesn't mean we always have to, because you might not even believe in charting like I do. I'm devout, but that also, I mean, you can do this with anything. You literally can. It's just a matter of, you know, what type of risk you want to take. To me, a good encouraging chart pattern puts the odds even more in your favor, and then you bracket that option pair around the stock to create the collar. That's what they call a collar, this pair. Okay, and then game plan it in advance. Just like I said, if the stock goes way down, it's below the put strike, but the put strike is your minimum. You can't do worse than that, okay, plus whatever cost of the options. If it goes up through the call strike, I just went through that, and you know, what if it goes nowhere? Well, if it goes nowhere, you know, it might cost you a little bit if the options net cost you a little bit. But again, it's case by case. And by the way, that's why I would like this to be as small a cost as possible. Okay, so let's look at the portfolio. And I just want to make sure here. Good. Yeah. Okay. So this in my chart system and you know, and your questions is what we have left today. Okay, so I'm going to just explain what this is, and then I'm going to go to the questions. If you have questions, put them in the chat now, or I am very happy to just have you open your microphones and talk to me. Okay, so I haven't finished the research, and let's face it, you know, who knows if the market will open tomorrow. I mean, it's kind of a weird time in America with transition and all that stuff, and you know, who knows what the next couple of weeks will bring, good or bad, for stocks. Okay, but frankly, one reason that I am going in, I would say, with more confidence to the rest of this year and beyond is because of what I'm going to show you here. Okay, this is a short list that I've gotten down to through a bunch of screens, and again, those of you who are in the service, you'll recognize, oh, we still own some of these. You know, I've gone from a lot of stocks down to like 6. Well, most of the 6 I think are in here. And then one of the reasons I held them is because I knew this was coming and I didn't want to sell them and rebuy them if I was going to consider them for a collar. So let's take CVX as an example, just because it's the first one up here. okay? And you can see these are all priced under $200, so that gives you some idea. All right, what's happening here? Well, step one, I would buy CVX for, and I would buy, let's keep it simple. 100 shares would cost me it would cost me about $16,000, okay? Now, the first thing some people would say is, wow, that's a lot of money to put in a stock from you, Rob. I don't know. I've only got, a few $100,000, it's over 5%. And, it's a lot in one stock. Okay. Keep this in mind. Normally when we buy a stock at 161, what's our downside? Zero. I mean, you could go to zero. That's what I mean. And downside is 161.47. Unrealistic, okay, in a case like this, but is the downside, half of that, 3/4 of that? Not out of the question. However, if you own put options struck at 160, guess what? 160, if the stock literally goes to zero, okay, assuming the options markets are still functioning and they're liquid and I think in a lot of ways more secure than other types of investments, been around for a long time. The 160, think of it this way, okay? And I'll tell a quick story, because I always like to honor my late father who taught me a lot of stuff about investing. He was drafted around the time of the Korean War. I think the war was pretty much over, but he was in New York City and they were going and giving him, I guess everybody was getting called, okay? Your number was coming up for the draft. And, this one's like, oh, you're going to whatever middle of Nebraska, nothing against Nebraska. You're going to Alabama, you're going, upstate New York where you're going to, freeze your patootie off, okay? Then it comes up, Isbits, California. And he's like, here I am, here I am, here I am. And he tells a story about running to the front of the room and everybody's like, oh, this guy got California. So anyway, that's a quick thing about my dad. But it reminds me of, that's how I feel if I own CVX as an example. I bought it at 161.47 and the stock goes to 130 next week. Here I am. I still have the right to sell this for 160 because that's what a put option is. As long as it's 100 shares and 100 shares. If I own 500 shares of this and one options contract, the other 400 are, floating in the wind, available to be lost on, okay? But that's it. So, and again, expiration date, everyone's going to be different. And I look at multiple ones of these and I can show you some of my sources because I found a really, really good source that I've used for a long time, but I'm really starting to power use it now. Bar chart is the site. So expiration date, let's say 5 months away. In this case, these are, live examples as of Friday. Okay, and what this is saying is, all right, CVX, I buy it for 161. My downside's 160 and my upside's 185. This is not bad, right? The question is, okay, how much is it going to cost us, okay, for that? All right, how much is going to be sort of out of pocket? Okay, now again, in this case, all right, I'm looking at a bid here and an offer. I'm sorry. Let me see here. Yeah, bid and offer here. Okay, and I'll clean all these numbers. This is a sort of a sample. Okay, based on recent numbers, but this is what I'm looking for. Okay, the stuff in yellow are the keys here. All right, 185 to 60, and what I'm looking to do is, okay, it's going to give me how much upside I have and how much downside I have. And I'm going to try to finagle these numbers so that my cost is as low as possible. And I will end up with a lot more upside than downside. Okay, so there's 3 pieces here. There's the call option I should say, let me start it. You buy the stock, you buy the put option, you say, this is my low. You sell the call option, and this is my high for the next 5 months. Remember I said, there's a few different things that can happen. If the stock goes below 160, I can sell at 160 anytime. Also gives me the luxury if the stock goes to 130, because how many times have we seen this happen with these types of stocks? Let's say CVX goes from 161 to 130, and it does it in next 2 weeks. Well, I can hang out knowing I can't do any worse than this. I can just, and I think the options market actually does this automatically for you now. If the stock's below 150, it's going to exercise the put for you, is what we call it. So if this has gone down to 130, and I mean, who's to say that by June, it's another earnings period passes, and maybe the stock gets back up above 160. Maybe it goes all the way to 185. So this also allows us to wait it out. One reason I love T-bills the last couple of years, as I've mentioned many times to our subscribers, I like T-bills because it gives me a chance to wait and see what happens. This does too, as opposed to, gee, I'm down 20%, the stock's at 130. What do I sell? Do I buy more? I don't want to have to deal with that. These markets don't operate the way they used to. So I can't expect them to be as friendly to me as before. So I want to basically dictate my rules of engagement. Do you ever roll your covered calls? Yeah, that's part of what I said in one of the slides. The thing about the dog collar is it's flexible. It's flexible, okay? You could make changes at any time, okay? In fact, one of the things, let's say again, I'll just stick with the one example because hopefully we're familiar with it by now, but if CVX drops to 130, all right, the put options are going to go up in price because it's going to kind of simulate, the closer we get to this day, it's going to simulate, oh, these put options, well, if the stock's at 130 and we land on this date, guess what this put option is going to be worth? $30 a share, okay? Because I have that ticket, okay? Like the late great Carl Isbitz, my dad, getting drafted in the military, $30 because I can sell this with my little ticket here, my put option for 160 and the stock's at 130. Therefore, it's worth 30 at expiration. In between, it's all a bunch of Greek math, which I won't share with you. Now, the other thing that happens if it goes down is the call options, whatever you brought in, and in some of these cases you can bring a lot in. Okay, this 450 would probably go down to like 10 or 20 cents. The other option you have, pardon the pun, is to close out the call options, take that off the table, and you can just own the stock outright. And if it bounces back, you don't have a higher end of this. Again, a detail for later. So as far as rolling the calls, that refers to, okay, we're getting close to this. And again, it's always situationally specific. Frankly, that's why I think it actually fits really well into the SunGard YARP portfolio service on Seeking Alpha, because that's the only place that what I'm doing and what I'm thinking regarding all this is displayed. I might do a little bit of it, examples here and there in Seeking Alpha, mainstream premium articles, but just a little bit. So, as you get closer, I'll give you an example of when you would roll it, okay? So let's say that it's early June and the stock is sitting at $170, okay? Well, it's a long shot to get to 185. It's also a long shot to get to 160. So the options are going to be down in price. So, if I'm 170 on the stock, I'm up in price. I've been getting my dividends, which is helpful. Okay. And then I will, but my profit on the stock is perhaps reduced a little bit by the net cost of the options. At that point, when the options aren't worth very much, unless I really believe something's going to happen, maybe earnings are coming up, something like that, I will. It would be very easy to close out the options worth zero and start over again. There's all kinds of ways to do this by adding on pieces. And frankly, the best way, I think, is going to be every time such a situation comes up, even if it's something I don't necessarily believe in my heart of hearts is the best thing to do, I may do something to say, here, I did this like in a trading portfolio or something, so I could show you a real live example and track it. I like to do that. I'm an educator.